Hey, this is Peter Cunha, your New Jersey real estate giant, broker owner of Open Doors, sitting here with my buddy.
David.baum, branch manager of our cross country mortgage in Tinton Falls. How's everybody doing today?
Good. So listen, you and I have been talking about a lot's going on in this real estate market. There's a lot of confusion. Interest rates are obviously volatile as they've ever been.
Sure.
We were talking about, I guess, what options do people have right now in the non-traditional sense of what's out there other than conventional and FHA, VA type stuff?
Sure. Thanks. Good question, Pete. So basically right now, a lot of people are, they're not only are they looking at the traditional financing, if they're looking in the conventional space, they are right now adjustable rate mortgages are being a little bit more attractive for some people in the event that they have a plan on, the future, whether they're planning on being in a property for a fixed certain period of time, or, they're savvy enough to think that down the road they might be able to refinance. Remember, you want to basically, people that are looking to buy a house right now, they're trying to marry the house or not marrying the payment, right? Payments, payments can change down the road with a refinance potentially. Over historically, people have mortgages for around 7 years. If you look at the last 80 years on paper, so people either refinance, they upsize, they downsize. So adjustable rate mortgages are a thing right now. Some people are potentially doing temporary buy downs to maybe get a short. Go ahead.
Let me ask you something about the ARMs, because and again, I had an ARM when I bought my condo in Asbury.
Sure.
There's what options? I know that there's 3, 5, 7.
Yeah, there's 3, 5, 7, and 10. However, on the 3 and the 5 year, you got to be careful that it's not going to be a high cost loan right now. And the reason for that is there is a note rate, and then there's a qual rate, and the qualifying rate on a 3 and a 5 year adjustable rate mortgages. They actually add 2 points on top to whatever that rate is. And they use that to make sure they can qualify at a higher monthly payment, because it's going to go up in less than 7 years. So on a 7 and a 10 year adjustable rate mortgage, they're going to qualify you at whatever rate it is. And then when you're doing that on the adjustable rate mortgages, they're, pricing on that, it's a slightly riskier product. So not all investors are looking to offer that, but the ones that are, there may be a discount point or something involved. And you just have to be careful that it's not a high cost loan, that it cannot even be written. And the shorter term ones where the prices change, the 3 and the 5, they are becoming a little more high cost versus a 7 and 10. So you have to look at everything in the grand scheme of things. It's a little complex, but I'd be happy to talk, on a case by case basis with everybody, and and certainly see what works best for a client. But adjustable rate mortgages typically 3, 5, 7, and 10 years, and they're typically every 6 months. After that period, it can adjust one time every 6 months. Typically, it can't go up by more than 5% in that first initial rate hike period. And then typically it can't go up more than 1%. There is a floor as well, and there's a ceiling. So just depends on which investor and which product you go through. There are different, percentages it can go up, whether it's 1 or 2 on every 6 months with a max of 5. But once again, it's going to depend on the investor that the client is looking at, and the terms can be slightly different between investors.
No, that's awesome. And then, you and I were talking about it. It's I'm doing a seminar in a month, right? And a lot of people are, people want to buy houses like that.
Sure.
Ultimately, people want to buy houses.
Sure.
And a lot of people are saying, hey, listen, let's ride this out a little bit until the spring market. Typical stuff that you get on a seasonality part, right? And I'm going, why would you wait? I get it. You're a little timid. Interest rates are a little high right now compared to what they were at, what COVID, kind of created. From my perspective on the real estate front, it's listen, let's look at houses. Let's see what's out there. Let's see what your mortgage payment is. You might be able to find something, because guess what? Sellers are just as afraid as buyers are right now, right? And they might be able to, the people that are selling will take offers just
Mhm.
because they want to get out of their house because, maybe they can't handle it. I just did another, I just talked to an attorney and he was saying, especially seniors that are on fixed incomes, they can't handle, excuse me, they can't handle what's going on right now, right? Because
Mhm.
they're on fixed budgets, inflation's crushing them right now. We're trying to figure out ways to help those people out. And
Yep.
sometimes the only way is to, kind of downsize. So,
Huh?
it is a good opportunity.
It's a great, and just talking about that real quick. So getting back to that whole other product thing, because that the one of them is absolutely related to a senior citizen community. We offer reverse mortgages, right, to help for purchases or refinances. We're seeing a lot of that right now to help out the senior community.
Sure.
I'm seeing a few other products that we're working in the non-QM space, and it's adding additional buyers to this market that may not be eligible for financing with traditional products just based on qualifications. We've got bank statement programs, we have asset qualifier programs, we have investor cash flow programs, we've got 1099 programs for self-employed that just went from W-2 to self-employed. We do foreign national products. I mean, anything that might be able to help bring additional buyers to the market. We have a plethora of
Right.
products out there to help just about anybody in this market.
Right. And that was the other thing. It's like the non-QM stuff. A lot of people are just afraid. It's kind of like you mentioned the adjustable rate on a short-term loan. It's they don't want to pay that extra 2%.
Mhm.
And a lot of people that I deal with are like in the Brazilian and Portuguese community that, they're working on their social security cards, tax ID numbers. Are you doing anything with that as well?
ITIN loans, yes, we are. We have a few investors. I think anywhere from as little as 10% down for a
Okay.
product on that.
Yeah.
But each investor is different, as well as there's different, qualifying ratios. The higher loan to value, they're gonna, they have to look at everything a little more in detail.
Right, and that's funny because, when you go underwriting, everybody thinks that it's apples to apples. Their buddy bought a house, they put down 20%,
Sure.
and, the biggest thing that I always the knock that I get is, I don't think that, the lender's doing them justice because my buddy was able to buy a house and I wasn't.
Right.
They go, "Well,
Yeah.
oh, your credit card? What kind of car are you driving?" You know?
Yeah, I mean, debt to income ratio, like we talked about last week. I mean, there's so many factors that affect one person qualifying and one person not qualifying. I mean, and there's nothing discriminatory about it at all. It's black and white on numbers, right? And some investors, we typically don't have any overlays, but on niche products and things like that, you have to fit the bill, to qualify. So
Right.
it's, everybody in every scenario is different, not one person is alike.
Yeah. So Dave, one of the things that I appreciate about you is like, just giving people options, right? And
Yeah.
a lot of lenders, they go through the script and, it's all right, this is the product that my company's pushing and this and that. I know you and I have worked with some, what I would, at the end of the day, looking back at it, I didn't think that we're ever going to qualify for a house. But,
Mhm.
we were out there looking, because of your guidance, we knew what our parameters were and we were
Mhm.
able to make deals work. So, one of the things that I noticed on the video that we didn't discuss is what's the best way to contact you to learn more about these non-qualified traditional mortgages?
Sure. I mean, the best way to reach out to me is give me a call on my cell. I'd be happy to chat, or email. So, cell phone 732-853-4969. You can reach out to my website and inquire. Just go to david.baum.mtg.com, or you could shoot me an email, david.baum, DAVID, period, BAUM, at myccmortgage.com.
All
And
right,
I'll be happy
awesome,
to set up a consultation and go over everything.
awesome. And Dave, I, as always, appreciate doing these calls. I think they're more important. I saw a chart on the volatility of the just interest rates on a weekly basis. And,
Yeah.
I don't blame people for being confused. And, at the end of the day, all these newspapers, these social media sites, they're there to get clicks and views. So, it's gloom and doom all the time. And, we don't know that to be, certain. We've been in these markets before and we'll get out of it again.
Mhm.
So, Dave, listen, can't wait to do this again next week and appreciate your time, man.
I appreciate it, Pete. Take care. Thanks a lot.
Better, bud. Bye.
Bye.